Dear Vice President Dombrovskis, dear Gabriel, dear friends in and around our beloved insurance industry, dear colleagues, thank you very much for joining us. Showing up on a Sunday afternoon, just close to holiday season, very warm outside, football championship going on, in a very dark room on an afternoon, either shows a very high degree of passion and dedication or masochism, I just do not know. I would assume all of us are here voluntarily and signed in voluntarily. And as a private person, I want to thank you for this very special commitment. It reminds me to some cinemas, I have to be open, Michaela, in Vienna. Cinemas, old cinemas tend to look like this in Vienna. Unfortunately, the movie which I'm going to show you now is not a new movie to you now, right? Because you know this movie for at least now for more than 14 years. And the other second bad message is that there have been people already on this stage here, Olaf and a great panel before, who talked about the movie. So I'm going to show you and present you the highlights of the summary. So the summary of the summary, okay? Please forgive me, it just will take me something like 15, max 20 minutes. The only thing in order to make it not too boring for you is that they will be very straightforward and honest and personal. So 3 messages. First, as a private individual, thank you for showing up, highly appreciate this. Second, as CEO of a mid-sized insurance company, you know we are not one of the huge giants of this world, but as CEO of a mid-sized European insurance company, we benefit a lot from Solvency II over the recent years. We received over the last years a different perspective, a different view, a kind of 3D perspective on our business, on the risk management, on the capital management, and especially on the governance. Towards the public, we had a clear strategy. We never ever complained about Solvency II. We used it as a kind of transformation support, as a booster for transforming the business model and for telling our people, our guys, look, we have to adapt because the whole world is adapting, so let's grab the chance like being proactively. And I do not say that there are not some negative topics or some issues we have to discuss about, but this is normal if after 14 years, after many years of discussion, you implement in a big bang at once such a huge framework. And this brings me to my third point, and this is now my official part as President of Insurance Europe. Having been implemented in a big bang was the one thing, but the other thing is that the whole environment in the time when it was developed and implemented was a crucial one, because it was a time of the financial crisis. And I think it's normal and it's human, it's not criticized by me now, that because of this, the overall tendency of Solvency II, to some extent, this is our opinion as insurers, is conservative, and in some parts maybe too conservative. But again, no reason to blame someone, it's just reasonable if you think the logic behind how it was developed. Thanks God, we have the chance that we have 2 reviews, one in this year and one by the year 2020-21. Therefore, I think we got the unique chance right now to really carefully evaluate jointly, okay, if we have Solvency II putting right, or if there's something what we're going to should adapt. Our insurance companies, the European insurance companies overall, are managing assets that are equal up to 60% of the whole European GDP. And this means that we are playing a substantial role in the European economy, and of course we are willing to keep this role and even to expand it to the benefit of the society and of the European citizen. But, dear Commissioner, we may ask ourselves 3 questions. We must ask ourselves 3 questions. The first question is, how are our assets currently invested? The second question is Solvency II measuring the right risks? And the third point is, what is the link, what about the link between the prudential framework, which we appreciate, and our investment capacity? And in response to those questions, I may thank you, dear Vice President, first for all your efforts, which you and the Commission did in the last time in order to make some improvements on solvency. First, as all of us know, Solvency II recognizes now infrastructure investments as a separate asset class and is the first standard, as far as I know, globally to do so. Moreover, you have also rightly suggested to align capital requirements for infrastructure investment more appropriately to the overall underlying risk. The second improvement which we see is, and we highly welcome this, to remove unnecessary barriers to investment in securitizations which meet the criteria for standardized transparent securitizations by again aligning the capital calibrations with the real risks. This is why our industry over the last years always welcomed very much every single opportunity to exchange views, to find common solutions, and to discuss how to improve our framework. And this included the Capital Markets Union Call for Evidence, and as I mentioned, the preparation for the reviews in 2018 and 2020. About this year, about the review 2018, and I'm sorry that I repeat something which all of us in this room are aware about or know, but I have to give the message again. We have got two issues this year. The first topic is about the risk margin. Currently, and this is our position, it will not surprise you, and Olaf was addressing it in a very good speech this morning, currently removes over 200 billion euro of potentially productive capital from our balance sheets. And this is not a money which our industry needs to pay the claims of our customers. All European companies it requires all European companies to set aside extra money, but you know it is only needed in the extremely rare case of one company potentially failing. Apart from the fact that the amount, as we think, is much too high, we believe there are more efficient ways to address the problem. We therefore urge you now, meaning already under this review in 2018, to address this topic and to reduce the risk margin to signal the Commission's aim of putting capital to productive use. The second topic, which is crucial for this year, and also no big surprise for you, is about equity, long-term investments in equity. Long-term investments risks is lower than trading risks. But unfortunately, and we keep on repeating this message, unfortunately, the Solvency II capital charges are based on the overall assumptions that us insurers are trading most of our assets, and we do not trade them. Recalibration to reflect the real risks would therefore allow us to invest more in equities, a class of assets which is central to us, but also to the whole European economic growth in the future. There are, however, certain aspects currently in Solvency II which we would not like to touch because we think it makes sense that they remain as they currently are. Let me please also mention two examples of them right here. First, we welcome the Commission's recent declaration to leave the interest rate capital calibrations unchanged. Such changes, as we believe, would have an enormous negative impact and are directly related to wider and, as we think, more fundamental questions on the evaluation methodology. EIOPA has also suggested imposing new European-wide restrictions on the amount of tax recovery insurers can use to offset capital requirements. And these limits, as we know, are set locally and take into account the local tax regime, the nature of the business, and the evidence to justify tax recovery. There are legitimate reasons to avoid new limits and instead reinforce the current principle-based approach that encourages supervisory judgment and dialogue. We therefore call on the Commission not to impose these limits during the 2018 review, as this would be a clear step away from the principle-based regime towards a more rules-based framework. About 2020, and Olaf was mentioning it this morning, we did a survey. We asked all our member associations, we asked the member firms about their impression, their feelings, their experiences with Solvency II. I'll begin with three very good and positive messages. No big surprise. 100%, as we heard this morning, 100% of our respondents said clearly that Solvency II had improved risk management and governance. Strong 89%, which is really a lot, said that data quality had been enhanced, and still, remarkable 76%, more than 3/4, said that asset liability management had been strengthened. And I think this exactly is what I said at the beginning of my speech today. However, of course, no big surprise, we also received some kind of critical feedback, what to improve. More than half of us, like 58%, stated that Solvency II has contributed to a negative effect on our overall ability to offer long-term savings products with guarantees. And around the same percentage stated that Solvency II has led us to invest less than optimum amounts in assets such as equity, long-term bonds, private placement, or also unrated debts. We are therefore at risk of having fewer long-term investments in the economy at the time, dear Commissioner, when the Commission wants to boost sustainable growth within the European Union. And the question which we ask ourselves is just how can this match? How should this match? So in order to get Solvency II right, the Commission's 2020 review should address first the overlay, as we think, too conservative overall approach, Solvency II, and second, the fact it treats us insurers as if we were short-term traders when we are, in fact, mostly long-term investors. At the same time, it's important for us to highlight the impact that improvements to Solvency II can have. We ask companies if calibration improvements on infrastructure and securitizations or those under development by the Commission on unlisted equity and unrated debt would have a positive impact on their performance. Over 65% answered yes to at least one of those questions. And I should note, and please forgive me, no big surprise for you, that 43% said that lowering the calibration for equity risk would also have, of course, a positive impact. Distinguished Vice President Dombrovskis, this leads me now to linking the Solvency II reviews with your political agenda, an area in which Solvency II can impact citizens' life is, of course, and I think you have one opinion about this, pensions. As you know, the European insurance industry strongly welcomes your initiative to develop a pan-European personal pension product, as there is a clear need to significantly expand the scope of privately funded personal pensions. As all of us know, there is a serious gender pension gap. Women, on average, earn 16% less than men, but when it comes to pension, this gap widens up from 16 to 37%, which is a lot. New form of employment, increasing self-employment, temporary employment, whatever, will lead to declining levels of contribution, of course, to Pillar 1 and to Pillar 2. Let's look also at geographical challenges within Europe. As illustrated, we have differences. The average net income per month in the European Union is slightly above 1,500 euros after tax. But it differs between, for instance, Bulgaria at around 400 euro net per month after tax, and Denmark, which is more than 3,000 euro net per month. I know the Commission is keen to target citizens that currently do not save at all. It's fine, it's clearly understood. But you are thus targeting markets with little or no pension savings offer. And your target citizens are typically those people with lower average salaries. Here, it's just important to recognize that the lower the income is, the more difficult in practice it is for the people to save up for their retirement. However, it's precisely when you have little to spend that you want to make extra sure that your savings are really safe then. So what is a safe personal pension? I think the European citizen, no matter where they're living, if they live in Bucharest, if they live in Lisbon, will tell us that this is a product that guarantees at least what was paid in, and ideally, of course, more than this. No big surprise. So they expect a safe but also attractive pension product. Can we insurers, can we offer safe and in the same way attractive PEPs? Is this possible at all? Yes, we think economically we can do it. It is possible if the product is genuinely a long-term one. But now is the link to solvency, and you know our concerns about this. We think that Solvency II is making it currently really difficult for us, if not impossible, as first, capital requirements for long-term guarantees and investments do not reflect the real risks and are too high. This is caused by the way how liabilities are valued. This is caused by the way how high risk margins as well as the high capital charges for investment assets are treated. And second, in addition, Solvency II creates too much volatility by not fully reflecting the economic link between insurers' assets and our liabilities. The very concrete consequence of this is that the risks related to pension savings are shifted, and we saw it, I think, this morning from Olaf in a very impressive chart, that they are shifted on the shoulders of the individual person who saves for its pension, which in turn make them reluctant to really save their money in the first place. Therefore, we think that the 2020 review must address these issues and result in capital requirements that are better reflecting the real long-term risks which insurers face. I think we have one shot with this European pension product, a European label, a brand that promises, and this is what our industry stands for, trust. A European brand, a label that promises safe and attractive pensions could bring the much needed trust to these more, I would say, fragile groups in our population and to the markets where personal pension offers are underdeveloped. This would ensure that pensioners live out their life later on, their retirements in security and dignity. But for that, safeguards need to be taken that the European Union label is indeed delivering on a safety promise. The current PEP texts, as we know them, are just stating that the PEP should be safe, but there is a complete lack of how we define safety. How in concrete should we understand it? How do we mean it? If this is not addressed right now, we run the risk that the European pension label will be damaged, because depending on the provider, no question if insurers, if asset managers or pension fund, depending on this, the PEP will deliver different levels of pension safety. And we think that this cannot be a really desired outcome. Please allow me also one very short comment about sustainability, also a topic which was raised today, also during the very, I think, impressive and vivid panel this morning. Insurers already, no big surprise, is our self-understanding from the nature of our business since centuries. Insurers also play a variety of roles in promoting sustainability and want to be able to do more on this. But again, Solvency II capital requirements currently are simply too high for us as far as our stronger engagement in sustainability is concerned. This creates barriers for growing our investments in this field, and as before, this is something to be discussed, as we hope, in the review, not this year, but in 2020. Ladies and gentlemen, coming to the end of my summary, and sorry to be so dry and so technical, but to end again on a very clear and positive message on Solvency II. Our industry keeps on strongly supporting Solvency II on the one hand, and second, on a very strict risk-based supervision approach. The concerns I have raised have been raised, as you know, by many others too, including recently, as all of us know, in the final report from the Commission's high-level expert group on sustainable finance. As far as the review in this year is concerned, 2018, the risk margin, improving the risk margin, and the equity calibrations are the most crucial topics for our industry. As far as the for sure more extensive 2020 review is concerned, the HLIG report provides recommendations on the overall specific issues that this review should address. Therefore, we look forward to the Commission making good use of the reviews to follow up on the Solvency II issues and to address the safety aspects in the ongoing PEP discussions, which we strongly support. As Insurance Europe, dear Vice President Dombrovskis, dear Gabriel, we highly appreciate our cooperation. I can state that our industry has grown up during the last 14 years. I think we learned our lessons, and I think we clearly are aware about our overall responsibility towards our stakeholder in a global, not only European-wide, but global competition. We stand ready and are happy to work with you also in future on the long-term valuable role which we can play and which we want to play for this continent. Please trust us. We know what we are saying, and I think that we also know what we are doing. Thank you so much.